think now we're at a point where the economy is trying to put itself on a sustainable upward trajectory, but inflation is throwing mud in the gears of business.
Welcome, everyone, to another episode of Inside the Markets presented by StockPulse.com. We are more than honored to be sitting down today with Peter Boockvar. Thank you so much, Peter, for joining us today. You're the Chief Investment Officer of Bleakley Advisory Group. What are you keeping an eye on in this environment as the year comes to a close?
I think right now the inflation story is the most important for many different reasons. First one being if it's direct impact on the economy, the impact it has on consumer spending, the bottlenecks that it creates for a variety of industries, then of course has an impact on the response function of the Fed and other central banks around the world as they're all dealing with the same problem. And then what that means for markets, because markets are basically on a foundation of an inflation environment of maybe 1.5% with extraordinarily low interest rates. So where inflation sort of settles out over the next couple of years, where interest rates settle out, how much the Fed pushes on the tightening side will all determine where things go out, play out in 2022. Because as the economy goes, yes, so goes markets, but I would argue that in the environment we're in, more so where the markets go, so goes the economy, unfortunately.
Do you believe that the Fed is going to seriously consider tapering moving forward?
Well, they've already started. Just a question of whether they make it through to the end. Do they speed it up? Right now, they're doing it by $15 billion a month for 8 months. There's some internal chatter from some Fed members that we've heard of the past week that they're going to look into maybe quickening that taper. And if they do that, then I think the market's not necessarily prepared for that because rate hikes potentially could follow sooner rather than later.
So I guess let's take a step back and look at the last, is it 18 months approximately since March 2020? How would you characterize this time in the markets, in the economy, politically, et cetera?
The Fed and other central banks made monetary policy extraordinarily easy. They bought up a lot of assets, and that helped to lift asset prices. Obviously, the work from home during 2020 lifted the work from home stocks, and everything else got hit. And then you had the Pfizer vaccine news on November 9th, and that shifted attention to, okay, what's life going to be like reopening again? And those stocks rallied. I think now we're at a point where the economy is trying to put itself on a sustainable upward trajectory, but inflation is throwing mud in the gears of business. And while all from March 2020 through now, we had extraordinary accommodative central bank policy that is now in the midst of reversing itself. However glacial and slow, it's still going to be a reversal, and it's still going to be something that other central banks are going to do at the same time.
Where do you see inflation heading from here?
I think the rate of change will probably peak out in February at around 7+%. And then the comparisons get tougher. So on a rate of change basis, as 2022 progresses, the inflation rate will slow. But that's just the math of tough comparisons. I think the question is does it slow to an above trend pace of maybe 3 to 4%, or are we quickly going back to where we were pre-COVID? And I argue the former, not the latter, and that we're still going to be in a 3 to 4% type inflationary environment, which may seem low compared to the 6 to 7 or 8 that we're going to see, and certainly less than what we saw in the 1970s. But as I said earlier, the world's not set on a foundation of 3 to 4% inflation, also considering how much debt is out there. And in terms of where interest rates can go in a 3 to 4% type of environment. So that would be sort of a new normal if I'm right, and inflation ends up being more sustainable and persistent.
What other parallels are you seeing, if any, between the 1970s and today?
Well, in terms of how widespread inflation is, this is the most intense inflationary pressure since the 1970s. On a wholesale level, we're seeing inflation rates the same as the 1970s. If you look in Europe on a wholesale level, PPI in many different countries in Europe are mid to high double digits, in the 15 to 20% range. That's the 1970s. If you calculated the US CPI and you plugged in home prices instead of rents, you'd have 10% inflation, the 1970s. So there are definite parallels. There are differences, of course, too, where back then the economy was much more unionized. That's much less so today. But labor nowadays is becoming more empowered and looking for more wage increases. And while it may not be necessarily under a union structure, it seems that Amazon and Walmart and Chipotle are all willing to pay $15 to $20 an hour, which is a form of wage inflation that a lot of other smaller businesses are not going to be able to replicate.
What do you think that portends for small businesses in particular, which already saw quite a bit of pressure in 2020 on their bottom line?
Well, this is challenging for them. Again, Chipotle can afford to pay their employees $18 an hour and with benefits, but a local restaurant with maybe one or two or three locations, that stresses their P&L to a much greater extent. And some businesses, some restaurants, to again use that as an example, may not be able to be profitable with those kind of labor costs unless they are able to pass on higher prices to their consumers, or they can somehow mitigate that higher wage cost through faster productivity. But when you're running a full service restaurant, unless you're going to have robots serving every table, it's going to be hard to offset that by productivity, and you're going to have to raise menu prices instead. So they're least able to absorb it compared to the Walmarts. And I worry about those smaller businesses.
What sectors of the economy do you think might benefit from all the different pressures on the economy? Which assets, which commodities, perhaps?
Well, those businesses that have pricing power are able to get through an inflationary time much easier. If you're an oil company and you have rising oil prices, you obviously benefit from that inflation. If your customers are less price sensitive to what you're selling, you can pass on those higher prices. But it's a question of how quickly you can do that. Many businesses aren't able to pass on their higher costs just all in one fell swoop. So they're going to piece it out. But that means that margins are going to get impacted for a period of time until they are able to fully recapture that margin hit. So it is going to depend on what industry you're in, again, and what pricing power you have to mitigate the business expense from higher costs, not just of labor, raw materials, transportation, packaging, and so on.
What are you expecting for the holidays? There's been word of double the amount of dollars people will be paying for their turkeys. There's been reports of tough times at Christmas, particularly due to the supply chain crisis, which perhaps you have some comments on. But closing out the year, what are you expecting over the next month plus?
Well, consumers, particularly upper-end consumers, are pretty flush with the markets doing as well as they have with parts of the economy well past where they were in the first quarter of 2020, or at least January, February 2020. Then, of course, you have a lot of money that was sent out to people over the past couple of years. So the savings rate's high for lower to middle income people. And that seems to continue with the child tax money that's gone out. So it seems like it's going to be a very good Christmas. But a lot of that increase in spending is getting eaten up by inflation. In March of this year, we had a big spike in retail sales because the checks went out from the Biden stimulus package that was nearly $2 trillion. And if you look at where retail sales, just specifically retail sales, since that March spike through October, so that 7-month time frame is actually running, if I got my count right on that, is actually running at a slower pace than the increase in CPI. So volumes are actually lagging, and a lot of the increase in consumer spending is price. So that's going to be an interesting dynamic with Christmas. You can't just look at what the dollars are spent. You really have to try to take out price and see what volume is in order to really have a true gauge of retail sales this holiday season.
Which investments are sticking out as the year closes that you think might perform the best? A lot of the people we've spoken on here on the show have been emphasizing that gold and silver are eventually going to run. Other commodities, for instance, what are you keeping an eye on?
Well, I am bullish on gold and silver, but I've been that way for the last couple of years. And just when you think that they're ready to take off, you get beaten down, like today's sell-off. But I've also been bullish on energy stocks and agriculture stocks and uranium and some international markets. And I think that there are plenty of good value in beaten up stocks that have been neglected by everyone focused on the bigger cap technology stocks that are performing fundamentally pretty well, but just valuations that I necessarily can't stomach personally.
Internationally, is there any region on the planet or country that survived 2020, if not unscathed, looking in a better position than you might expect, or many other nations comparatively?
Well, no one's unscathed from what we saw. Obviously, certain countries have dealt with it different than others, with some having no tolerance for COVID and others trying to get their people vaccinated and opening up, understanding that COVID's going to stay with us. But when I look out over the next 10 years and I look at where the best growth rates with the most attractive valuations are, I continue to get pointed towards Asia, and not just China as a growth story, even though they have a lot of challenges right now with their real estate market and how their economy is going to transition away from property to other things, where the next couple of years are going to be tough for them. But there's a growing middle class story in China and also the rest of Asia that I think is pretty exciting. So I even like Japanese stocks that where the Nikkei is still trading below where it was more than 30 years ago, and stocks in Singapore and South Korea and Indonesia. So I think that there are opportunities outside the US, and I think it'll be important to be geographically diversified over the next couple of years. If I'm right on inflation, if I'm right on Fed tightening, and the sensitivity that higher multiple stocks could have in the face of that.
What challenges might China face, particularly on the real estate property market front?
Well, China is hugely dependent on residential real estate, and that area, their economy is turning down. And to the extent that it does on a both a development standpoint in terms of new construction, but also on a price standpoint, because so many people in China have essentially parked savings in apartments where there's a lot of net worth, probably north of 75, 80% in real estate. So as real estate prices go, could determine where consumer spending goes. And like I said, on the construction side, that's going to slow dramatically. So there's going to be a transition. I'm not sure what they're going to transition to. I just think that they'll be much less dependent on the property sector. And hopefully over time, that ends up being a good thing. And particularly from a leverage standpoint, since real estate is sort of a levered asset to begin with. But it's going to be a bumpy transition for them.
What are some of the sectors they could transition to fuel further growth and drive the economy?
In China?
Yes.
Well, over the next 5 years, the size of the Chinese middle class is going to double from about 300 million people to 600 million people from some estimates that I've seen. That's basically adding an entire US in terms of the middle class. And when you become middle class and you make more money, you want to consume, you want to travel, you want to buy nice bags, you want to go out for dinner, you want to provide for your family in a way that you weren't able to before. So that at the same time, I still think China is going to be a manufacturing powerhouse as they've proven to be able to produce the things that we need with very sophisticated infrastructure. So that's where I think the Chinese economy is going to go. Again, manufacturing will remain strong, I believe, and that there'll be more of a shift to consumer spending and consumer wealth.
How can the US compete?
Just as we've been competing with the world for 250 plus years. It's just trying to stay ahead on the technology front, and just as we've been doing, but also not being afraid of competition.
Do you have any thoughts on, speaking of technology, on, for instance, blockchain? There's been a lot of talk about, for instance, China incorporating a distributed ledger-based digital currency. There's been some talk of the Federal Reserve experimenting or investigating the same question. And then there's the wider question of blockchain technology generally. I think in the year 2015, we saw a lot of Fortune 500 companies starting to look into blockchain, and then over the years, increasingly adopt it. I would have as a aside, a footnote, that a lot of the technology that they're ultimately experimenting with isn't pure blockchain technology. It's more little distributed ledger-esque technology, but nonetheless, it's been branded as blockchain. Let's just call it blockchain since they're doing that. So do you have any thoughts on blockchain as a sector, as perhaps a potential to drive the economy of nation states or otherwise?
Well, there are a couple of things in everything you just said. The digital currency out of China is going to be very specific to China. It'll be a way for China to basically track every transaction that takes place in that country if they go full digital. The US, I don't think, is necessarily going to shift to that because there's major privacy pushbacks, and we don't really want to be depositing our banking account money at the Fed and having them track everything and having them dictate bank lending. I mean, I just think it's a dangerous place to go to have a central bank digital currency. I think on the whole blockchain itself, yeah, I mean, it's a revolutionary technology that so many things are going to shift to, and there's going to be major disruptions in the financial infrastructure that we are accustomed to, and there's going to be a lot of intermediaries that are going to get hurt by this transition.
What should we expect from 2022?
In terms of what?
Economic, financial, inflation?
Well, I touched upon a lot of the things that we should expect in 2022. More persistent and sustainable inflation, and many of the world's central banks that are going to be tightening policy in response. And I think that will create more of a bumpy road for asset prices and, in turn, economic growth.
Do you anticipate a period in the precious metals like we saw during the 2011-2012 run-up? We saw silver approach $50. We saw gold at $19.20. Those are markets in those commodities we haven't seen since. So do you anticipate something along those lines happening at the tail end of the 70s? We saw something similar.
I think so, and I hope so, since I'm bullish and I'm long for myself and clients. So yeah, I hope that's the case. I do think that's going to be the case. I think inflation is going to run faster than the Fed's ability to control it. I think the Fed's going to be tightening at a snail's pace. I think other central banks will be tightening at a snail's pace, and that real rates, inflation-adjusted interest rates, are going to remain deeply negative for a while.
Even just the last 10 years of monetary policy and the options that are available to the central banks should be a bullish enough case for gold in the first place, let alone if they taper at a snail's pace, as you say. What are your thoughts on the miners in gold and silver as well?
Well, they'll certainly do well if I'm right on the price of gold and silver. Miners really took on a lot of debt in the late 2000s and early 2010, 2011. There was a lot of empire building. There was a lot of poorly run companies and none of them were prepared for a sharp decline in the price of gold and silver. I think after sort of 10 plus, well, I'd call it 10 lean years, I think a lot of companies have improved the way they run their business. And I think there's a lot more leverage, even though they're not immune to a lot of the cost pressures we're seeing right now. I think there's a lot of leverage in these business models now, and there's a lot of money to be made for them if gold and silver continue to hire. Many of the well-run companies now are doing well with $1,800 gold and $25 silver, but those margins can get really fat if from here prices go much higher.
And you've been tweeting recently about the property market in the US. What comments do you have on that?
Well, the residential real estate market's been red hot, and we've seen 20% year-over-year price increases. and the rental market is red hot too. But it's red hot if you're a seller. It's really not that much fun if you're a buyer or you're a new renter. And I do think that there are some signs that consumers are getting sticker shock on the buy side, and not only as a first-time home buyer, particularly since they're buying their first home and they don't necessarily have a high-priced home to sell in order to upgrade. They're not only having to pay those prices, but they're becoming skeptical of paying those prices, and they're competing against institutional buyers that have muscled their way into this market that has also goosed home prices. But I think we're reaching an inflection point where those home price increases will at least slow the pace of those increases. And if mortgage rates tick up, there's a risk of them actually falling just because they've gone up so much.
You've been listening to StockPulse.com's Inside the Markets. We've been honored to have as a guest today, Peter Boockvar, the Chief Investment Officer of Bleakley Advisory Group. Thank you so much, Peter, for joining us today.
Thanks, Justin. I appreciate having me on.
And thank you, everyone, for listening.